All right, so it's just after 7 o'clock Eastern, and we're going to get started with tonight's webinar. It's going to be our final webinar prior to summer. I want to welcome everybody to our very successful year of webinars to date, and I really want to reach out to all the sponsors that have helped make this a very big success for our organization at CAOMS. Just a reminder for anyone who has not turned off their camera or microphone, please do so now. Since our last webinar in May, we've had quite a few changes. Many people are getting their first vaccines, others are getting their second vaccines and are fully vaccinated and hoping to travel soon. Who would have thought that we'd have a Canadian team in the Stanley Cup semifinals? It's either one of the Montreal Canadiens or Toronto. I'll let everybody figure out who's actually in the semifinals right here. Don't want to press a sore button for anybody. And with summer officially beginning in a few days, this being our final webinar, I just want to mention one important upcoming event. We are having a joint meeting with AMOS down in Nashville, Tennessee. It's going to be the 103rd national meeting in the US, and we've had several joint meetings over the past. It will take place September 29th to October 2nd. The plan at this point is to have both a virtual and in-person event. We are hopeful that the borders are going to open up for everyone that's vaccinated, so we would love for everyone to be able to attend. We know that there's still concerns regarding quarantines and all that, but we've had quite a few people reach out and ask about booking, and we'd like to ensure that until we get the all okay from the Canadian government, the plan at this time is for us to be down there in person as best as possible. I do want to thank Carl Bouchard, Mike Shimazu, and Joey Friedlich for helping be the point people for our organization with the scientific committee down at AMOS in Nashville. So thank you very much for recruiting everybody for speakers. Now, proceeding on with tonight's webinar, we always want to make sure we are providing a variety of education to our members. I wish to thank Dr. Kevin Lung from Kingsway Oral Surgery up in Edmonton for suggesting tonight's topic. And I wish to also thank CIBC Private Wealth Management for sponsoring tonight's session. Once again, we will take questions following the presentation, so please send them through the chat. I will be moderating the chat. Unfortunately, Tony has a prior commitment, so please send them to me through the chat. In the next hour, we will hear from two speakers, both from CIBC. The primary presentation is on estate planning, and then we will receive a brief overview on a program CIBC has developed specifically for oral surgeons across Canada. I'd now like to ask Dr. Kevin Lung to say a few words.
Thank you, Miller. I first want to thank the CMS and yourself for coming up with this brilliant idea to organize these webinars over the last year. I found them very rewarding and exciting to be on the leading edge. Ken Hayward is now going to be introducing our featured speaker. Ken is an investment advisor and portfolio manager at CIBC Wood Gundy in Edmonton. He's been looking after myself and my family's financial investments for over the last 30 years, including RSPs, TFSAs, my PC and my IPP, my independent pension plan. I've been extremely pleased with his service and his attention to detail. I speak to him almost every day, which he may or may not like. And I can say without a doubt that Ken saves me time and makes my life much easier. Because of Ken, I only have maybe one more good week of work to do before I retire. So hopefully you'll have someone like Ken organizing your future. I look forward to hearing this presentation from Jamie about my next move. Maybe it'll be moving to Panama. I don't know. It depends if the Trudeau government continues on. And now I'll let Ken introduce Jamie Golombek, and I'm looking forward to this presentation.
Thanks, Kevin. For those of you who know him, you will not be surprised when I say Dr. Kevin Lung is my most exciting client. While most investors were extremely cautious after last year's crash, Kevin recognized the opportunity and bought stocks pretty much every day through the spring and summer. Thank you, Kevin, for making those dark days a little bit brighter. One day, Kevin called me and said, "I want you to find me a tax and estate planning rock star." So I said, "We have to get Jamie Golombek." And we did. Jamie Golombek is Managing Director, Tax and Estate Planning with CIBC in Toronto. As a member of the CIBC Private Wealth Management team, Jamie works closely with advisors from across CIBC to support their clients and deliver integrated financial planning and strong advisory solutions. He joined the firm in 2008 after 12 years with a global investment company, where he was involved in both internal and external consulting on all areas of taxation and estate planning. Jamie has also worked for Deloitte as a tax specialist in the Toronto office, where he specialized in both personal and corporate tax planning. Jamie is quoted frequently in the national media as an expert on taxation, writes a weekly column called Tax Expert in the National Post, has appeared as a guest on BNN, CTV News, and The National, and has been a regular personal finance guest on the Marilyn Dennis Show. He received his BCom from McGill University, earned his CPA designation in Ontario, and qualified as a US CPA in Illinois. He has also obtained his certified financial planning and chartered life underwriting designations. Jamie is a recipient of CPA Ontario's Award of Distinction, which honors those CPAs who have made an early impact, bringing distinction to themselves and to their profession. Jamie is a past chair of the Investment Funds Institute of Canada's Tax Working Group, as well as a member of CPA Ontario, the Illinois CPA Society, the Estate Planning Council of Toronto, the Canadian Tax Foundation, and the Society of Trust and Estate Practitioners. Jamie also teaches an MBA course in personal finance at the Schulich School of Business at York University in Toronto. Please welcome tax and estate planning rock star, Jamie Golombek.
Thanks very much, Ken. Just make sure everyone can see me and hear me. I've been doing lots of Zoom seminars over the past year, and the best story, I teach the MBA course. Of course, it was all virtual this year, but I remember telling the students a few months ago that there was a story out of Singapore where a calculus math course was taught for 2 hours straight. No students asked any questions. And at the end of the 2 hours, he noticed that he was actually on mute the entire time, but no one said anything because they didn't want to embarrass him. So if you can't hear me, now is your time to speak. I'm going to speak for 30 to 35 minutes or so. I'm going to go over the three main agenda items. Obviously, we're going to go beyond the professional corp, but we need to start with the professional corp. Why do you even have it? Do you know how you use it? Are you using it properly? Are you doing everything you can to really optimize the tax situation of your professional corporation? Then we're going to look at some basic tax strategies that we're using with all surgeons across Canada that we work with, high net worth individuals, of course, whether they be doctors, lawyers, and of course yourselves. And then of course, we'll talk a little bit about testamentary trust. Now, I don't know why it says crust there. Maybe someone was hungry when they wrote this slide, but obviously we're going to talk about trusts and not crusts. Professional corporation, let's begin. So professional corporations are a big topic. We've written a bulletin. I'm going to send you afterwards. We have a website with all of our material, and we'll show you exactly where that is. But we've written lots of bulletins. I'll pop up 6 or 7 of them throughout today, so that if you want more information, you can certainly reach out to Ken at Wood Gundy, and you can reach out to Chloe, that we'll hear from a little bit later on our private banking. We can get you copies of any of these or send you direct links to the PDF versions of all of this. So what are we talking about? So professional corp, there's really 2 advantages. One is the ability to do some income splitting, and the second is the ability to leave money that you don't need to spend in the corporation to invest long-term, and that's the primary benefit. But if I could start very quickly with the salaries, of course, if you have a corporation, of course, you can pay salaries to do some income splitting with your spouse if they're involved, or the kids with the business, with the practice. But again, you've got to make sure, and I'm sure you've heard this before from your accountants, that the amounts that you pay are reasonable. So if your spouse or partner or kids helps you with billing or office or whatever, just make sure that the amounts are reasonable, or CRA will challenge that and deny the deduction to the professional corporation. course, the more common way to do it is dividends. And the basic structure is you've got your dividends paid from the corporation to yourself, and then you've got the typically, depending on what's permitted in the particular province, because I know we have all provinces permitted across Canada represented tonight, you may be able to have the family members, either a spouse or kids, depending on minors, or they're over the age of majority as shareholders. And then the question is, can you pay them dividends? And this is where, of course, as many of you would know, the rules came down hard and heavy about 3 years ago, when the government basically stopped you from income splitting with dividends from your professional corp to a spouse or kids that are not actively involved in the business. So you got to be very careful here. I think that for the most part, this type of income splitting is dead. It just cannot be done. Now, some people did this via a family trust, where you'd have your professional corp shares owned personally. Maybe you have non-voting shares, depending on the province, owned by a family trust. And then the dividends would be flowed through the family trust and ultimately paid out to the spouse and the kids. Again, these new rules, these TOSI rules 3 years ago, pretty much prevented all attempts at income splitting for a spouse, partner, and kids if they're not actively involved in the business. Who's subject to this TOSI, this tax on split income? Basically, if you own 10% or more of the company, or you're actively involved with your professional corp, if you pay dividends or any kind of income from that company to the specified individual, which is your relative, your spouse, your kids, etc., then that is considered to be split income. And the consequence of doing that is that those dividends are taxed at the highest rate to that individual, which basically killed most opportunities for income splitting. There is still a limited opportunity here. So, for example, if you have a spouse or partner, once you are at least 65, the corporation can be effectively used for income splitting. So this is commonly what people are thinking about. So you're thinking about ultimately a retirement plan where you've got your professional corporation, and then finally at the end of the day you are 65. No matter how old your spouse or partner is, you could start paying them dividends even if they're not involved, and that will basically be a way of income splitting if that spouse or partner has a lower tax rate than you. This is basically what's left in terms of income splitting. I think it's the only thing that's left, unless the spouse, the partner, or the kids are actively involved, meaning 20 hours a week or more in your business or your practice throughout the year. So again, pay attention to that. That is not the primary reason why you have a professional corporation. The primary reason, ideally, is so that you can leave money inside of the professional corporation. So again, let me show you a basic example. I'm going to show you Alberta, then I'll show you all the other provinces in just a second in a chart. But basically, if you've got $100,000 of net professional income, that qualifies for the small business rate. In Alberta, for example, the tax rate on that is about 11% on the first $500,000. That means that you net $89,000. If we take that $89,000, we want to take it out of the corporation. We pay ourselves a dividend of $89,000. We pay tax on that dividend at the top Alberta rate. Then we net about $51,000 after tax. That's really the same mathematics, by the way, if you never had a professional corp. So imagine if you have $100,000 of net professional fees, and you paid that to yourself as a $100,000 salary. So the corporation has no income. You pay tax of, let's say, at the top rate in Alberta, 48%, you would net $52,000. So you can see that really there's not much of a difference on a net basis, whether you earn income subject to the small business rate in your professional corp or you would have earned it personally. The difference, of course, is the deferral advantage. You can see at the very top of the slide, that's the magic of the professional corp. Assuming you don't need to spend all your money every year on living expenses, you can defer 37% tax forever by leaving it inside the corporation. Now, this is on the first $500,000. Once your income is over $500,000 on a net basis, that deferral drops a little bit. So if I can just pull up this chart for you, it's a little bit busy. Let me take Ontario as an example. If you follow the chart with me, what I'm showing you in ON for Ontario is that there's a negative cost of 0.59%, which is negligible. It's basically 0.5%. Every dollar that you're earning in your professional corp basically is costing you about 0.5%, versus if you had earned it personally and paid tax at the highest rate. That being said, in Ontario, the deferral advantage is 41.3%, meaning if you can afford to leave the after-tax income in the corp, you're deferring 41% forever until retirement or beyond. And that's the main advantage of having a professional corp. Now, once your income's over $500,000 net, the cost jumps to about 2% negative in Ontario, and the deferral drops down to 27%. So bottom line, lots of numbers here. If everything's working properly, you're getting a very nice deferral, and you ideally want to leave all your money inside the corporation with one caveat. And the caveat is, again, 3 years ago, a major rule change that says if you earn too much passive investment income inside your corporation, the government will start clawing back your access to the small business rate when you have over $50,000 a year of what we call adjusted aggregate investment income. And that's your interest, your dividends, that's your capital gains, that's your rental income, any income inside of your corporation. So effectively, once you have more than $50,000, you start to lose your small business rate when you have over $150,000 in your corporation, or if you have a holdco in all your corporations, you're going to lose the small business rate, which in the end of the day is not that big a deal, because as we saw in the previous chart, it costs you a little bit more. Your deferral is a little bit smaller. So as an example, in Ontario, if it was 41%, it drops to 27%. The good news is that, in fact, Ontario is a bad example, because Ontario is the exception, because in Ontario, the government of Ontario said that they were not going to follow this rule. So in fact, in Ontario, there's no disadvantage of any kind earning a passive investment income in your corporation. You don't lose the Ontario small business rate. You actually end up with a better tax result. In all other provinces, what we try to do is what we try to effectively, for the most part, minimize our investment income so that we don't have, on a realized basis, more than $50,000 a year, so as not to lose the small business rate. So we've written a whole article about this, planning for passive investment income inside of your private corporation. Number of ways to keep income below $50,000 a year. You can use a buy and hold strategy. Ken at Gundy is very familiar with this, where you buy and you hold. You don't turn over the portfolio every year generating gains. You want to defer those as long as possible. You want to maximize RSPs and TFSAs. I'll talk about that in a second. We'll talk about IPPs, and we'll talk about life insurance. We've done a couple of studies. Again, these are all available online, that all business owners, including professional corps, should be maximizing your RSP and TFSA every year. We've proven mathematically that every year you should be paying yourself enough salary to be able to make the maximum $26,000 RSP contribution and make the maximum TFSA contribution, because mathematically it'll be better at the end of the day by taking money out of the corp to be able to make them that RSP and TFSA contribution, which can't be done inside the corporation. If you want more information, again, you can get a copy of these bulletins. Another thing you could think about, we've already heard a little bit about it, the individual pension plan, which is basically setting yourself up for a beautiful defined benefit plan from your professional corp. Basically is a pension plan for one person. There's the annual contribution limit is often higher depending on your age than you can put into an RSP. Get some creditor protection there. There are some ongoing fees, which may be worth it depending on how old you are. If you're over 40, I think it's worth taking a look at. Again, if you speak to us at Wood Gundy, we'll set you up with an actuary, no obligation. We'll get you a quote for your professional corp, and it allows you to basically save a little bit more for retirement. In my experience, depending on your age, you're probably looking at additional 15 to 17% over a 30-year period in terms of additional accumulation inside an IPP. We can model that for you. We don't even do it. We have an outside consulting firm that does it. We'll take a look at it for you. The other thing you can do, of course, is use life insurance. The problem with investments inside of your corporation is that they earn income, and that income is all taxable. When you want to take the money out, you also have a taxable dividend to pay it out. If you buy permanent life insurance inside your corporation, you avoid this tax problem because all the income inside the policy is tax deferred. And then if you die, which most people do, the entire amount can be paid out through the tax-free capital dividend account of the corporation, ultimately as a shareholder, and then ultimately to the beneficiaries. So it's a way of basically extracting the cash from your corporation on a tax-free basis on debt. It also is a way of basically sheltering investment income from that clawback of the $50,000 small business deduction. So let me show you a quick example. We've got a couple here, Stefan and Julie. They've got about $2.5 million of small business income trapped in their professional corp. if they had to pay the money out of their corp and they live in Alberta, the tax rate on that income is 42%, which means that if they wound up the corp and paid a wind-up dividend, the cost would be $1 million. If they don't need these assets for retirement because they've got other assets, what they could do is, instead of taking that $2.5 million, investing in some kind of conservative fixed income, low interest rate, 3% type GIC, you could even get 3% these days. What they're going to do instead is they're going to fund $1 million through a permanent UL policy, universal life policy. So if we get a quote, 67 and 65, joint life, last to die policy, $1 million death benefit. If we get level premiums on this, we're looking at about $33,000 a year for 25 years. The cost of the insurance is $831,000. Why would you pay $831 to get $1 million? Because it converts taxable to tax-free. Because what happens is, if we had used just a GIC, we're building up value inside the corp. When we take the money out, we're going to pay tax. If instead we build it up inside of a universal life policy, depending on what year you die, your rate of return changes, right? So if you die the first year after buying the policy, great news. I mean, not for you, you're dead, but for your estate, you've now increased the value of your estate by about $1 million on an after-tax basis. If you live to joint life expectancy, if this couple was about 90 years old, then you're looking at an increase in value to the estate of about $500,000. So these things work. We can customize, again, speak to us at Gundy, we can run the numbers for you, and we can mathematically model the accumulation inside a policy to see what works for you. This is just universal life. If you want a higher rate of return, you can look at things like whole life, etc. We're now going to leave the realm of the professional corporation, and we're going to get right into what can you do outside of the professional corp? What can you do personally? Assuming you've done everything right inside the corporation, what can we do beyond the professional corporation? Well, let's start with our tax rates. We were trying to minimize tax. We have 5 federal tax brackets this year. The top rate for most of you, 33% on the federal side. Then, of course, you add provincial or territorial rates on top of that. You get this beautiful mess over here on the screen. Let's take an example. Let's take a look at Quebec. So Quebec, for example, if you have dividend income, you're looking at a rate of 40% from like public company dividends, like CIBC dividends. If you're getting money out of your private corporation, your professional corp, where you've paid a small business rate, your effective Quebec rate is about 48%. On capital gains, it's about 26%. And top rate in Quebec is 53% on regular income. So this is kind of where we're looking at in terms of, looking to minimize tax. We're dealing in 8 out of the 10 provinces with a tax rate over 50%. And that's something we really need to focus on, whether we earn capital gains that are 50% taxable, we move to an eligible dividend structure where we're getting tax rates of closer to 35, 40%. And that's one of the things we look at in terms of tax effective planning. So we can do the same thing, by the way, with life insurance on a personal side. I'm a big fan of insurance for people who don't need insurance. In other words, we take the same example. We've got Marie and Lewis, 65 and 67, got $1 million, and they don't need this for retirement. They want to leave this to the estate. If we assume an Alberta top rate of 48%, they could choose to invest this in a fixed income portfolio, for example, if they're very conservative, or they can choose instead to buy a permanent insurance policy. That could be UL, could be whole life. I'm going to show you, just in the interest of time, the UL policy. So we've got 2 options, right? We've got the $1 million GIC. This is personal, no corporation, no PC. The PC is somewhere else. We're doing, what can we do with our personal money to stop paying tax at this high Alberta rate of 48%? So option 1 is we just buy our GIC. We earn 3% a year. Option 2 is we take the $1 million, we put it in a GIC, but every year we fund this joint life policy of $33,000 a year for 25 years to pay the premiums on that particular policy. Here we're using a quote that we got this week from Sun Life. So if we actually run the math on this, if we look at the GIC, the numbers are very straightforward. So the first year, if you die, you got your $1 million, you bought a 3% GIC, 3% of $1 million is $30,000, 48% tax on that is about $14,000. You're dead, you get $1 million of GIC, and you get $16,000 after tax. Very straightforward. We do the same thing every year. At life expectancy, you got $1.4 million. If instead we took the same strategy and invested every year some of the $1 million into premiums If you die the year after you buy the policy, you're ahead by almost $1 million. You're dead, but your estate is ahead, because effectively what you've done is you got your $1 million, you bought a policy that paid out another $1 million. So less some of the costs of the insurance, a bit of tax, you've got a $2 million value starting on year one, ultimately going down to about a 1.7 million at life expectancy, joint life expectancy for the couple. So basically we're increasing the value of the estate from anywhere from 300,000 to $1 million, depending on when you die, right? So it's up to you in terms of the planning. This is a basic UL. We can do a lot better if we use other insurance, things like whole life policies. I can tell you that most professionals in Canada, specifically doctors that we deal with, surgeons, dentists, surgeons, etc., they're all doing insurance. They're doing tons and tons of insurance because it is the most tax-effective way to increase the tax after tax, tax-free value of the estate. So again, I call it insurance for people who don't need insurance. It's worth taking a look at. Let's move beyond insurance. For the kids, if you've got kids, you're any remote chance they're going to go to education, you want to make sure that every year you're funding the RESP. You can do that to the tune of $50,000 per kid. You're going to get a maximum matching grant on $500 a year. So the basic scenario, most people delay, and then they hear about the RESP and they finally do it at age 10. But if you do it at age 10, you can catch up slowly. The maximum you're going to get from the government is 20% on $36,000. That's a legislated maximum. So if you put in $1,000 when the kid's age 10 and then double up every year, $5,000 to age 17, you put in the $36,000. If we assume just a conservative rate of return, 3%, very conservative, no risk, we'll have $48,000 when the kid goes to school, and that works out to 4 years of education of $13,000 a year. Now, we can do better, right? Because if we do the same funding strategy, but we start when the year the kid is 0, when the year the kid is born, and we put in just enough every year to maximize the government grant, on the $2,500, we get a 20% grant, we get $500 a year. So eventually we stop, the kid's 14, we've hit in our $36,000 in the plan, we got a 20% grant. So all of a sudden now we've accumulated $61,000 for education. That funds 4 years of school at about $16,000 a year. But can we do better? And that's the point of today. So if you've got extra money lying around, could you be funding the $50,000 for each of the kids, even beyond the $36,000 on which you're going to get the grant? And the answer is, of course, you should be doing this because it's giving you a complete tax shelter. And effectively, our recommendation is take the $16,500, put that in up front, which is the first year's $2,500, and then that excess of $14,000, that's the difference between the 50 max and the 36, that gives you the grants, because you don't want to overfund it at the beginning, because then you're going to lose all the grants for the next 13 years. So we're going to put $16,500 in the beginning. We're going to follow up $2,500 a year. We're going to end up with $50,000 per child. And at the end of the day, we'll have $85,000 for your education. That pays for 4 years of $22,000 a year. And the best part of all, in almost every scenario that we've seen, this $88,000, right, $22,000 a year for 4 years, is all tax-free. Now, how is that possible? Very simple. The $88,000, $50,000 of it was your own money. That comes out tax-free. There's $38,000 left over. And effectively, if that's taken out by the student over a 4-year program of undergrad, that's looking at about $10,000 a year of educational assistance payments. But remember that the student has the basic amount of $14,000 basically, where there's no tax. And if you look at undergrad tuition in Canada, it's probably a bit low. It's about $6,000. So you're looking at about $20,000 of credits, $10,000 of income, $20,000 of credits. They can still have a summer job or a part-time job and pay no tax on the RESP. So think of an RESP as a TFSA for the kids under age 18. You should consider maximizing the RESP, $50,000 for each kid in this strategy. If anyone here has a family member with a disability and they qualify for the disability tax credit, there's another opportunity here to put aside up to $200,000 for that individual and get substantial government grants and government bonds, $70,000 of grants and $20,000 of bonds just for making bare minimum contributions of $1,500 a year into the plan, depending on your income level. And again, let me show you this basic example. Just by putting in $1,500 a year for the person with a disability over 20 years, you could potentially put in $30,000 gets $70,000 of grants, depending on the family qualifying income, $20,000 of bonds. Again, a 3% conservative rate of return will get growth of about 46,000. The value of this plan, at the end of the day, you can see is grown to about 160,000, which is basically all tax-free because it's taxable in the name of the individual with a disability when the money is taken out. So that's equivalent to a 14.5% rate of return. So again, it's something to think about if someone in your family has a severe disability and they qualify for the disability tax credit. The next strategy I want to look at is income splitting in your family. We call it the prescribed rate loan. We have a wonderful opportunity as of last year called the 1% solution. And here we're looking at income splitting with your spouse or partner, even with your kids, which we'll talk about in just a second. So again, if I give my wife money to invest, all the income and gains attribute back to me. Because of the attribution rules, you're not allowed to income split in Canada. Instead, if I loan her the money and charge the minimum CRA prescribed rate, which is now fixed at 1% until the end of September, by the way, that's the lowest rate possible, any income or gains that she earns above 1% can be taxed in her hands. So it's a wonderful opportunity for income splitting. The nice thing is if you lock this in before September 30th, that rate of 1%, historic lowest rate in the history of Canada, can't be lower because it's always rounded to the closest whole percentage point, rounded up. You can basically set up 10, 20, 30 years of income splitting because you never need to adjust the rate on the loan. Let me show you an example. Here's a story of Jack and Diane. If you know the reference, you know where I was in about grade 7. So we're going to do a spousal loan, province of Alberta, 1% rate. So Diane is our high income earner. Jack is our low income earner. We're going to do some income splitting. So Diane is going to loan her husband, Jack, $500,000, charge 1% interest on the loan. So let's assume a 5% rate of return. So you got $25,000 of income that is now in the hands of Jack. But for this to work, Jack must pay his wife, Diane, 1% interest. So he takes the 1% on the $500,000, that's $5,000. He deducts that because he borrowed the money for the purpose of earning investment income, and therefore his net income is $20,000. Diane, though, is taxable on the $5,000. So our income splitting is the difference between the 25 and the 5, which is 20. So if Diane's in the top Alberta rate of 48 and Jack is in the bottom rate of Alberta of 25, we're looking at a savings here of $4,600 a year on just a $500,000 investment. So again, very interesting strategy, right? Now, you can do this with your spouse. You can also do this with kids. If the kids are under the age of 18, I would never loan my 15-year-old money because they'll never pay me back. So what I would do instead is I'd go to a lawyer, I'd set up a family trust and make a loan to the prescribed rate of the family trust, have the investment income earned side of the trust, and then use to pay all the kids' expenses. And if you use a dividend strategy that we often recommend, like public company dividends, then often those dividends can be tax-free. If you look at Ontario, for example, for this year, the magic number is just under $54,000, meaning there's no federal Ontario tax because of the basic credit, the dividend tax credit. Let me show you the example, because this is the other big strategy that most of our professionals across Canada, be they doctors, lawyers, surgeons, dentists, are using right now, especially if the kids are in private school or doing elite sports, and they're paying $10,000, $20,000 a year for hockey, lacrosse, things like that. So here we've got a couple here. You've got a couple, they got $1 million of capital. They earn 5% on that. It's a dividend portfolio. They've got a blue chip dividend stock. Top rate in Alberta, 34%. They've got about $32,000. And you got 2 kids. You see they're dressed for private school and they pay $32,000 of private school. Can we do better? Of course we can, right? So what we're going to do instead is we're going to take the $1 million. We're going to loan it to a family trust. We're going to charge 1% interest on the loan. The family trust is going to do all the investing. So what we're going to do here inside this family trust is we're going to have $50,000 of investment income, of dividend income, but we must pay interest, 1% interest on the loan. So we have net income of $40,000. So how does the tax look? What's going to happen here is we have to pay tax on the interest income at the top rate of 48%. So we have $5,200 left over. The kids are going to get $40,000 of dividend income, but pay 0 tax because of the numbers I showed you earlier, the basic credit and the dividend tax credit. So when you take the $40,000, which is tax-free, and you add the $5,200 of after-tax investment income, you have about $45,000, which effectively means that's $12,000 more than than you had in the previous scenario. So a lot of our families are using these type of family trusts to do income splitting to effectively pay for all the kids' expenses. So private school, extracurricular activities, the nanny, the share of the family vacation, you know, the plane tickets, if you need an extra hotel room for the kids, the children's clothing, any expenses of the kids can be paid for out of the trust effectively, and then deductible and taxable in the hands of these kids. So again, great strategy. If you're not doing this already, speak to your accountant. We've got obviously published material on this as well. What about charitable giving? So something a lot of our clients are looking at right now in terms of charitable giving is being very tax efficient, thinking about if you're making substantial gifts, you want a big tax deduction, but you're not sure where you want to give it to. One of our most popular strategies now is to use a foundation. Now, again, you can go to a lawyer and set up your own private foundation, pay 10 grand in legal fees, and every year have to worry about filing returns and keeping records and minute books and things like that. We have a solution for you. The solution is using a community foundation, or in this case, a public foundation that CIBC actually has a part of. So effectively what we can do is we allow you to transfer money into this foundation, get immediate tax receipt, either personally or through your professional corporation. You get the deduction now, but you don't have to decide where the money goes forever. The only obligation is to distribute 3.5% a year from the fair market value of the assets. So again, we have something called the CIBC Giving Back program. We can set up your own mini foundation called a donor advised fund in about 30 minutes. So effectively, it allows you to make a substantial donation to reduce your tax rate immediately for the current year. This is very common, for example, if we've got professionals that have just sold a building. So they got a rental building, they've just sold it, they've made some money, they don't want to pay tax. So what an opportunity now to park money inside of a foundation, get your immediate tax break, and then decide over the next 20, 30 years how much you want to give to charity. As long as you distribute 3.5% a year, you're good. So again, worth talking about again. Of course, we have a brochure on how that works. The last area that I want to talk about, because I wanted to make sure that we left time for your questions, is testamentary trust planning in the context of an estate. Years ago, testamentary trusts were very popular because of the tax rules. That changed about 6 years ago, where testamentary trusts are now taxed at high rates with certain exceptions. And therefore, why do we still recommend a testamentary trust as part of your estate plan? Well, a testamentary trust is not a legal entity. It's not a corporation, but essentially it's a relationship that separates the legal ownership of property from the beneficial use and enjoyment of that property. I often joke that you use a trust when you don't trust somebody. So why would you use a trust, especially why would you use one in the will? Primarily to protect assets for the next generation. So there's a lot of non-tax reasons why I might suggest using a testamentary trust. For example, if you've got a large life insurance policy that's going to pay out millions of dollars, you necessarily don't want the kids all getting it on the day they reach 18 or 19. We got clients that wouldn't want their kids getting it on the day the kids turn 40. So if you want any control at all over when the kids inherit their money, you want to have a trust in the will. Could be a life insurance trust or just a general trust that specifies at what ages the kids get the money. You could have, for example, staged distributions. The kids get half the money at 25, they get the other half at age 35. You may have what we call spendthrift beneficiaries, beneficiaries that are not good with money or shouldn't be trusted with a large amount of money. On a serious note, maybe they've got an addiction. Maybe it's drugs or alcohol or gambling addiction. Maybe they're just bad with money. They're not good at managing money. What you might want to do instead is leave the money to a trust, name a trustee to manage the money, and that money can be used for their education, for housing, for food, for rent, for shelter, for things like that, but they just can't spend the money freely. So again, that gives you a measure of control. The fourth idea, called the matching incentive testamentary trust, is to motivate the behavior of those kids. Some people are worried, we've seen this, you've probably heard stories, where kids receive large amounts of inheritance and that's it. They basically live on the trust fund, they stop working, they drop out of life, they're not motivated to do anything with their life because they're now living on the inheritance. So if you want to build an ethic into the kids, you're worried about it, you could set up a matching incentive trust. With a matching incentive trust, effectively what happens is you say to the kids, hey kids, for you to get money every year from mom or dad's trust, you got to prove that you've earned at least that much yourself.
So every year the kids bring a copy of their tax return with their notice of assessment to the trustee of the trust and say, look, you kids, you made 50,000, the trust will match that with another 50,000. You make 100, we'll give you 100. You make 0, you get nothing from the trust. Sometimes parents put a multiplier. You make 50, we'll give you 100. You make 0, you get nothing. So it's a way of incenting the kids to do something with their life, to earn some income, employment income, business income, self-employment income, professional income, to encourage them to continue to do something with their life so they can get some of this money from the trust. So parents love this idea, kids, not as much. And then finally, the last idea I'll share with you, and then we're going to head right into our short presentation on our offer for surgeons, and then into our Q&A session, is to protect the kids' inheritance in case of a remarriage. This is particularly important in case of a second marriage. So typical scenario, right? Most people here probably, if you're married or living common law, you probably have mirror wills. So when A dies, they leave the money to B. When B dies, they leave the money to A. And on the second to die, the money goes to the kids. This has always bothered me, because what if I leave all the money to my wife, and one day after I'm gone, my wife decides to remarry, and then she dies? She could end up leaving all my money to some new guy who I never even met, or hopefully never even met. And my kids could actually end up with nothing. So what I might do instead is set up a testamentary spousal trust in my will, give my wife access to all the income while she's alive, and then upon death, give her access to at least what she'd been entitled to on divorce, 50% of my assets, certainly in Ontario, but the rest of the money is sitting inside the testamentary trust and is available to the kids of the first marriage. See how there's no arrows anywhere joining the second family? Because I've cut them off completely from the value of my estate. So again, this is just a flavor for some of the things that one could do in terms of planning, estate planning, in the context of this type of trust. So we've been through a ton of stuff today, lots of information there. The idea here is not to make you an expert on any of this. The idea is just to whet your appetite for some of the planning that we do at CIBC with our clients. For more information on any of these strategies, Ken Hayward works with me at CIBC with Gundy. Certainly you can reach out to him directly. He's easy to find. Got his information on the screen. You can obviously Google him, very easy to find. He can get you copies of anything that we talked about today. He can set you up with a wealth strategist also in terms of talking about these strategies. What we're now going to do is I'm going to turn the floor over to my colleague who's going to talk about our special dental surgeon banking solution, specially made for you. So Claude, I'm going to turn this over to you. You can introduce yourself and tell everyone on the line a little bit about the offer that we have in store.
Thank you, Jamie. Hopefully everyone can hear me. My name is Claude Spencer, and I'm Senior and Private Banker with CIBC Private Wealth. Just to give you a quick summary of what CIBC Private Wealth is all about. It's technically a service where it's really integrated, and we have customized services and solutions to meet all of your personal, family, and business needs. There's 4 umbrellas that we fall under, where we have estate and trust, investment management, wealth and planning, and private banking. My role here today is more the private banking side. And I'll speak to you specifically about the exciting offer we have within our dental program. Jamie, you can do the next page. So within the offer, we have relationship management, where you'd have an advisor like myself that would be your primary contact within the bank. The advisor's role would be having conversation with you and your family about your specific needs, and then we'd create the solutions that we think will best fit and bring in the required professionals from either our estate and trust, investment, or wealth planning. But today specifically, we're excited to talk to you about the banking offer that relates primarily to your lending and mortgage and business. As you can see on the screen, if you're borrowing for your personal use or private or business use rather, we can get you a prime minus a quarter on any of those products. As well, for mortgages, you're getting it at staff rate, which is really great. And then for most clients, they're always looking for a way to save money on their fees. And if you have a business operating account for your PC, then that would be at zero fee for operating for that on a monthly basis. Jamie, the next screen. The same thing here relates to when we is offered when we look at your checking account or a high interest saving account and credit cards. All of these will fall under a very special service that we're offering to the dentists and dental surgeons that will cover just about anything that you and your family may need. If you do need further information on any of this, please follow the link at the bottom at mailbox pwmoffers@cibc.com. Over to you, Jamie.
Thanks very much, Claude. And we just wanted to mention that you should make sure you read all these legal disclaimers that our legal department made up. And there's 3 pages of these. So hopefully you've all read those very, very clearly. And now, that's the 3rd page of disclaimers. Now we get to go to the Q&A. So I'm going to stop sharing my screen. And just a reminder that I do have a website, jamiegolombek.com. Everything I've said tonight is there. I've got 100 publications there. My weekly National Post column is updated there every single week. I've got every article in the last 21 years that I've written is all searchable online. You can reach out to me there as well. And I'm going to stop sharing and open it up now for some Q&A. I wanted to leave lots of time. If there's any questions that you would like to discuss openly today.
So Jamie and Claude, both thank you very, very much for speaking to us. I do have a couple questions coming in, and once again, I'd like to reach out for everyone. Please direct any questions through the chat to me, Miller Smith, and I'll be happy to ask them. The first one I have is, tell us or maybe go a little bit more in depth into IPPs, individual pension plans. I know there was a lot of discussion about those and controversy about those with Morneau a few years ago. Essentially, my understanding is once you hit that cusp of age 40, that's where the real benefit essentially kicks in. But if you can kind of touch base on the IPPs,
Sure.
And then to that extent, what are those specific advantages centered around IPPs for each of us?
Absolutely. So look, an IPP, it's talked about a lot. There aren't. Look, I mean, it's not the most popular thing. I mean, in some situations, it can work very well. The goal of the IPP at the end of the day used to be much better. They changed the rules about 5 years ago, but it's still beneficial. Once you're at least 40 years of age, based on the math, you're going to start to be able to accumulate more money in the IPP than you could with an RSP. So all an IPP is a defined benefit pension plan set up for yourself. So think of those beautiful government pension plans that everybody wants to have, right? So with an IPP, they're allowing you, under the strict rules, there's a maximum amount that can be contributed to basically give yourself a pool of assets inside of the IPP that'll pay you retirement income. You can only set one up if you have a corporation. And also, you've been paying yourself T4 income, so salary or bonus. It does not work on dividends. So if you've been living off dividends for 10 or 15 years, you're not going to be able to retroactively go back and buy back years of service. That's really the big benefit. The benefit is to buy multiple years of service back from yourself effectively by taking a transfer out of your corporation, which is tax deductible to the corporation. You're funding it into a trustee pension plan. You need actuarial valuation, and it's all done properly legally. There's companies that provide all this, but at the end of the day, you need to sit down with one of these actuarial firms, complimentary, and do an actual assessment of your situation. They want to look at your T4 history in the last 20 years or beyond, if it's older than that, and they'll run the numbers, they'll run the mathematical projections. Again, my rule of thumb typically is if you're at least over 40, you should take a look at it, especially if you've got 10 plus years of salary income, not dividends, but salary income. And then they'll run the math and see projections. If you do the maximum every single year, how much will you end up at the end of the day in terms of retirement? My experience in the modeling that I saw as recently as last year was that you'll end up between 12 and 15% more money at the end of the day. So it's not a game changer. It's not going to change your lifestyle in terms of retirement. But if you're looking for every possible opportunity that one could do, I can't tell you not to take a look at it. In terms of, it's definitely worth looking at.
Now, is it true that you can share your IPP with your spouse?
Yeah, so absolutely. So with an IPP as well, first of all, if the spouse is a member of the corporation, an employee, you certainly can make her or him a beneficiary of the plan. However, normally what you can also do, just like with an RSP, is that even if they're not an employee, then effectively what you could do is you can split the income upon retirement. So in other words, once you're at least age, you start taking a pension, then that is eligible for pension splitting when you're doing take the money out, just like you could with over age 65 with a RIF.
Do you want to comment also on IPPs with the ability to top up, if your corp has losses?
Yeah, so again, one of the other advantages of the IPPs is that if the IPP has actually lost money, because there's a minimum funding requirement and it has to meet, then you can do an actuarial evaluation and they can come back and say, oh, well, the investments haven't performed well. The company can make a tax deductible contribution from the corporation to shore up the IPP. I try not to promote that because at the end of the day, we don't want you choosing investments that will lead you to that scenario. But it is a safety valve in the background if you did to have a value that actually has gone down in value. But hopefully you don't see that. Most of the portfolios that we manage in IPPs are fairly balanced, conservative type portfolios that don't run into that scenario. It could happen in a down year, but we don't see it very often. It's promoted all the time, but we don't see it in practice.
But overall, IPPs, if you're looking at it transitioning to age 40 or even beyond age 40, better investment program than an RSP.
Well, you can accumulate more money, all things being equal, in an IPP than an RSP, just because of the basic math behind defined benefit plans, which are just better than RSPs. The RSP limits are not as good as a defined benefit plan the way it works when you're older. Absolutely.
Excellent. Thank you for that. Other comments that we're getting, in my understanding, and certainly correct me if I'm wrong, capital gain strip and pipelines, are they one and the same? We're
Yeah,
hearing a
same
lot of
idea,
that.
right? Exactly.
Yeah.
And a surplus strip. And I recommend it because it's not going to be there forever. So, I mean, the idea right now is if anyone here has got, I don't know, I've seen some firms promote it for as little as $500,000. I don't know, professional fees are pretty expensive. So I think if you've got $1.5 million, that's the number I would use. We've seen this done like by every professional corp because they're so worried, right? Depending on the province, you have to look at Alberta's a bad example because the rates between the dividend rate and the cap gains aren't that different, but they can look at like Ontario, where I live, right? There's a massive difference between the top rate on capital gains and dividends, right? If your dividends are at 48% in Ontario on the small business rate, your cap gains is 26, you got a 20% spread, right? So if you effectively can do a surplus strip, which allows you, it's a transaction, the accounting firm or law firm, they'll promote it with you. It effectively allows you to strip out the money from your corporation at a capital gains rate instead of a dividend rate. The downside, of course, is you got to pay the tax today before you really need the money. So that's the cost. It depends how worried you are. A lot of people really thought it was going to go away in the recent budget. So we saw lots of stripping going on earlier this year where everyone was stripping all the surplus out of their corporations because they didn't want to get screwed if the capital gains rate inclusion rate jumped from 50% to 75%, because then the strip doesn't make sense. See, once the capital gains inclusion rate, if they ever would increase it as they haven't promised it, but there's a lot of rumors. If they went up from 50 to 75%, then all of a sudden your effective rate is basically the same as dividends in almost every province in Canada. And there goes all your ability to strip. So again, my advice to everyone here is my ballpark is about $1.5 million, because you're going to pay a lot of professional fees to get this done. It involves another corporation. It's complicated. But if you've got at least $1.5 million of retained earnings in your PC or your corporation, I would speak to your accountant or lawyer. If not, we can refer someone to you if you like. But just to run the math on it and see if it's worthwhile. And I would do it fast, because the government doesn't like it. The government, you got to be very careful and follow the rules for them not to challenge it. If it's done properly, it's still valid. But we know the government didn't like it. They tried to take it away in 2017. They backed off at the end of the day. But I think it's something that everyone should look at. I'm glad you brought it up.
And then can you also do any capital gains on your primary residence?
Yeah, so there's all kinds of plans out there. Like if you're really, I'm not as worried that the government's going to start taxing the principal residence exemption. I mean, they could do it. Maybe they'll put a limit on it. Maybe they'll prorate it based on years. There are transactions that people are doing right now where they take an asset and they transfer it into a trust. They trigger the gain. They claim the principal residence exemption, and then they roll the asset back out to themselves. It can be done. I think it works. Would the government then somehow catch that retroactively? Who knows? I'd say if your home is significant, like in the millions of dollars range, you've got a significant gain, it's worth looking at. But if your gain's a few $100,000, I wouldn't bother. It's not worth it. They're not going to retroactively tax the entire principal residence exemption without putting some kind of minimum threshold in there or giving you some kind of grandfathering for years prior to 2021. So again, remember right now in the US, the number I think is like 250,000 per person or 500,000 US per couple. That's a minimum I think they would do as a floor for the gain. So I'm not worried if you have a relatively small gain. I wouldn't start doing these fancy planning transactions. We saw it done in Toronto. We have clients that have homes in the 5 to 7 million range, and we know at least one of them that did it a few months ago, just before because they were terrified. They were terrified that the government. We have people doing all kinds of crazy things because they're worried about the government.
So to that end, obviously we've talked about having a bunch of these situations within our own PCs. Do you want to talk a little bit about numbered companies within your PC or numbered companies that are jointly held with your spouse, whether or not they have a PC as well?
Yeah, well, again, I mean, all the same things apply that we talked about. I mean, there's really nothing unique in the tax code about a PC. In fact, the definition doesn't really exist. It's just a corporation that happens to practice, the particular profession. So there's nothing really unique about it from a tax perspective. The numbered company, again, it's the same thing. It depends on the type of investment income that's earned. So if you have investment income earned in a PC, that's going to be taxed the same as an investment income earned in a numbered company. So again, some people use numbered companies to move assets around. You can strip the money out, especially if you're going to sell a practice. You're going to sell a practice. Maybe you sell the PC itself, right? So, I mean, some people want to purify. They use a corporation. They use a sister company via a trust. So some people do certainly use holdcos and numbers companies. But at the end of the day, all your associated companies that you control will be counted together for the purposes of that sort of $50,000 test, if you're worried about that in terms of losing the small business rate. So you're not going to be able to get around it that way.
Gotcha. Another question coming in. Any recommendations on transfer of recreational property to children to minimize taxation?
Yeah, be careful. So I just wrote a report on this last week. You can take a look at it. It's online. It's it's planning for your cottage. Just go to my website. I just wrote it last week. So I mean, the big issue I wrote about there is just be careful. Be careful. Number one, if you transfer it to the kids today, that's a disposition right away. So you might be creating capital gains tax right away, unless you claim it as a principal residence exemption, with the caveat that if you claim your vacation property as a principal residence and don't pay tax on the transfer to the kids, which is a deemed disposition, you've lost the ability to claim that exemption for your other home or your condo, whatever else you have, for those years of mutual ownership. So you got to be very careful to that. The bigger concern I have, of course, is you give it to the kids. Number one, the kids probably have their own principal residence. So now they've got the same tax problem as you. Number two, do you really want to do that? Because legally, you don't own it anymore. So if everyone gets along, great, fantastic. What if you have more than one kid? Do they all want it? And this is some of the issues that I talked about in my report that came out last week, because we are concerned that if you, give it to one kid and not the other, this creates a lot of problems. What if one kid can afford to maintain it? What if you haven't left funds to maintain it? What if the kid wants to do renovation and the other kid doesn't want to do it? We've seen so many fights in families based on equalization that, you have 2 or 3 kids. So that's why in our report, we recommend a cottage sharing arrangement or a vacation sharing arrangement. We discuss who gets to use it on Thanksgiving and who uses it at Christmas. And what if I want the July 1st weekend? And how do you resolve these issues? These are all very, very important considerations, not to mention having a sinking fund. In other words, a set of cash set aside by the parent, saying this is going to fund maintenance every year, who's going to do it? Maybe one sibling says, you know what, I don't have the money to keep it up, but I'll do all the maintenance myself. I'll go up every weekend and I'll fix up everything. I'll use my sweat equity and you guys use your real equity. Is that fair? So these are the issues. These are real serious issues. I'm glad you brought it up.
And to that end, I'll only speak on my own personal experience because this came up recently where if it's in the US, that creates even more tax implications, especially in my certain circumstance. 2 of my kids were American. So even though they're not of age, there are additional tax issues and other things that certainly come up, even though they're not even involved with that transaction, but because they're American and the property is American, there are certain situations where it creates a lot of confusion.
Yeah. So in that case, you want to get a copy of our other publication called Planning for Your U.S. Vacation Property, which we've written, which talks about all those issues. And then a third publication that we wrote a few months ago that talks about planning for U.S. assets and U.S. beneficiaries, where your kids happen to be U.S. people, and therefore they could be subject to the U.S. estate tax. So we've written lots of material. I encourage you to visit our website. All of these things we've written in the last few months, they're all up to date. They're up to date with the current Biden proposal on lowering the U.S. estate tax administration. And this is all things that we can help you with. We also have, of course, a private wealth division in the U.S. with offices in 16 different states. So again, if you have connections in the US, you want help managing money down there, getting a mortgage down there, things like that, we can help you on both sides of the border with CIBC.
Another one that's coming in, offshore insurance plans.
Yeah, I don't like them. I'm not going to talk about them. I've seen some sketchy stuff out there. Just be very careful. Be very, very careful with some of the stuff that's being promoted. I don't want to get into it.
Fair enough. On that note, I know Kevin Lung has some questions he definitely wants to pick your brain about. So I'm going to unmute him or ask him to unmute, see what he does.
Okay, I unmuted. What questions? Jamie, that was awesome, man. I love your energy.
Thanks.
I don't know. I just the thing is that when you look at IPPs, I like that you can. They have a fixed return that you have to get per year, and I like that if, let's say, you invest in, like, you have $1 million and you invest in some stocks, and the stocks go down, that you can top up and you get to get your money out tax free. That's a huge advantage over an RSP. An RSP for somebody who has a professional corporation, in my opinion, is a dead horse. Like, it's just, there's no advantage to it. I like IPP better. What do you think about that?
Yeah, well, I would disagree that it's a dead horse. I mean, I think RSP is better than nothing if you have a.
Yeah, I'm not saying nothing, but I'm saying, like, comparing it, like, for somebody who's a professional to have an RSP, or having an IPP, I think you can't top up your RSP if it goes into the tank.
But I mean, the goal is you don't lose money, right? I mean, you want your returns to be, you want your returns in a particular period to be higher than that threshold that are forced you to top up. I agree with everything you said. We came up earlier in the question that Miller talked about, that at the end of the day, you're absolutely right. So certainly if you have underperformed over a period of time, you're allowed to make a tax deductible contribution from your corporation to that plan, which is excellent. You cannot do that with an RSP. That's one of the benefits of the IPP. We hope that you never have to use that, because that means that your return is not meet that minimum threshold that's required under the defined benefit plan rules. But you're absolutely correct.
Yeah, but with an IPP, isn't it set up so you get a minimum of like 6 or 7% return that you have to get? And if you don't get that return, let's say you go conservative and you go into a GIC that gives you like 1.25%, right? Isn't the IPP set up to get a minimum amount of return per year so that when you're retired, you have cash?
Yeah, that's exactly the point. So there's a minimum funding requirement, and if you don't meet a minimum return, if you don't meet that, I think it's over a few year period, then you're absolutely right. You can put more money in there to make it up.
And that's 100% tax deductible.
It is deductible.
Any topping up,
sure, exactly. Just like all the contributions. Yep.
And then and Miller talked about this. So you can move your wife into your IPP. That's a huge advantage. So you can combine, and then you can, like you said, you can divide it when you're ready to retire.
Yeah, again, lots of planning opportunities. We have a lot of people with IPPs, so I think it's worth taking a look at. As I said earlier, like we work with two of the biggest providers of IPPs. We would want to run the numbers for you and take a look at the at your scenario. But you're absolutely right.
And what about whole life? You know, you hear about these whole life policies that, I mean, there seem to be a big advantage where you put large amount of money into premiums every year, and this thing grows and has cash value. I think the government changed the rule on the cash value that you can have. And any comments on that, on the whole life business? Even like, let's say you're older.
Yeah, no, yeah. I covered it. I covered it as one of the big strategies that we recommend. So corporate-owned life insurance. I showed a basic example using universal life to be conservative, using very, very low numbers that were guaranteed, turned to 100 type policies. But as I mentioned during the presentation, you can go much more than that. We're big fans of whole life. We use all the major products. And as I said earlier in the presentation, most professionals, doctors, dentists, lawyers, accountants who are high income are all using whole life. Because it's a great opportunity to effectively put money in it. You could borrow against it if you need the money. I don't promote that because ideally I'd like you to do it when you don't need the money. But yes, we're big fans of whole life.
Is there any disadvantage of starting when you're 55 or 59 or 60? Obviously the premiums will be higher, but is there any disadvantage?
No, it's still worth doing. We do stuff for people in their 60s, and we quick fund it. Like we fund it over 5 years. They put in like $400,000 or $500,000 a year. We adjust it. We play with the numbers, but we do all that all the time. Obviously, better to start it when you're young if you've got the cash. That's what our recommendation is. If you're in your 30s starting a career, if you can afford 20, 30, 40,000 a year from your practice, I would do it as soon as possible. The numbers are just so much better.
So to that end, Jamie, when you say running the numbers, like we always hear our insurance providers nitpicking, Manulife is better, Great West is better, and the specific ones internally. Is it just going to be based on your age, based on how much you're investing, go with the one that's going to provide you the best growth potential in the end? And currently, are there ones that are better than others?
Yeah, we look at all the big ones like the Manulife, the Sun Life, the Canada Life. There's about 3 or 4 really big ones that have the big whole life policies. We don't like the smaller ones, even though the rates might be better because you're limited also in terms of convertibility and options, things like that. And also, you really want to make sure that insurance company is going to be solid and strong and be able to pay it out, right? So we use the big 3 or 4 consistently. Probably mostly Manulife, Sun Life, but I mean, we use the big 4 all the time. Great West Life. I mean, some of them are owned by the same company. There's different names. But what we do is, we're completely independent. We don't care who you choose. So we actually shop it around. We'll take your set of facts and we'll say, look, how fast do you want to pay it? How much can you afford to pay? How much coverage do you need or want? And then we'll run the numbers with all the different software. We have software that can run all the different companies at the same time. And then we'll actually show you the illustrations. Well, here's what Manulife's offering. Here's what Sun Life is offering. What do you guys think? Because there'll be slight nuances to each one. And you also look at the performance, right? We'll look at what was their par account crediting on the Sun Life, for example, over the last 5 years, 10 years. How has it changed? Because they've all come down, right, in the last year because of the returns, right, on fixed income. A lot of them have fixed income in the portfolios, so they've come down. Some whole life products have a bigger equity exposure, which means more risk. Some of them have a lesser equity exposure, which means less volatility. So we look at all this, and we're completely independent.
And to that end, along the line of insurance policies, we've had a big change in some of our provinces outside of Ontario and Quebec recently with our malpractice. And as such, a lot of individuals are reaching out to us about recommendations on how to make them less exposed as individuals. Do you have any comments on specifically that about, essentially reducing as an individual or as a surgeon, my rate of exposure for, potentially a litigation or something like that, and offloading some of that, whether it's property or insurance or other things, to my wife or spouse or kids in order for me not to be exposed in that realm?
Yeah, so again, I really can't comment very much. First of all, I'm not a lawyer, and second of all, it's really outside of my area.
we hear concerns about it all the time. The only thing that I think is, certainly well accepted is, certain insurance plans where you name as an irrevocable beneficiary certain preferred people in your family. I think those are fairly safe from creditor protection in case of a lawsuit, as long as you didn't know about it when you bought the insurance policy, right? You got to buy it where this issue hasn't happened, or you're not aware of any lawsuit. Then there are ways to make an irrevocable beneficiary on the policy. Then you should be okay. Similarly, RSPs have been creditor protection for years now. Anything other than the last 12 months. So putting money in an RSP, obviously the IPP would give you that same type of protection. Those are the main things that I'm aware of. There may be fancy stuff, offshore, things like that. It's outside of my area.
Then you did comment a little bit about your spouse being a part of your PC. What if your spouse has their own PC? Are there other ways to benefit from a partnership engagement where both spouses have PCs, and how they may share a holdco together?
Again, there may be, without knowing specific strategy. I can't think of anything off the top of my head that I can share with the group right now. But there may be, other strategies that we would look at in terms of trying to make sure that each one of them gets the small business rate. Each one has their own PC. We don't have the cross contamination and being limited in any way. But off the top of my head, I don't have any magic ideas there.
Gotcha. Any other questions coming in on the chat? Kevin, did you have any other questions as well?
No, I'm done. That was great. Thank you very much, Jamie. That was amazing.
My pleasure.
And we're rounding up at 6:15. So once again, Jamie, Ken, Claude, we really appreciate all of you reaching out to our organization, sponsoring tonight's talk, and discussing very passionately about many very key topics that we're all concerned about, and we all know are changing on a day-to-day and month-to-month basis just with our current government. So really appreciate that, reaching out. And without any other questions, I'd like to end this evening. Once again, our big comments are Amos down in Nashville, Tennessee, September 29th to October 2nd. And our webinar series will resume again just prior to that in September. So just look out for emails from CAOMS indicating the next sponsor webinar. It will be a couple of weeks prior to Amos, just for everyone to know, and we'll continue moving onwards into 2021 and 2022 with our webinars. I hope everyone has an enjoyable summer. Thank you, CIBC, once again, and hope everyone has a good evening. Cheers.